And it's just typical, of August trading. These months are horrible, but we can always use this opportunity to do a little training. A gentleman who was tweeting me some charts on Twitter is listening in today, and really was having a difficult time drawing fibs. Paul, can you show this guy how you draw fibs, because it's important that you just don't throw a Fibonacci anywhere. Fibonacci is a retracement of a move, and that's the thing that you have to understand. It is a retracement of a move, whether you're looking for a move from low to high or a move from high to low. It's a retracement, and this gentleman is drawing them a little, well, actually backwards and upside down.
Yeah, here's
So
well,
they're
this is
very important that you draw them correctly, because
yeah.
you'll.
Here's a good thing is that well, I'm always talking about it. I think people would certainly take advantage of it. If they haven't, they're crazy. Was the Fibonacci webinar that you did several years back? That really turned the corner for me and really got me where I was able to pinpoint a lot of entries. And you know me, you were joking about me that a lot of times I don't hang on to my trades, but I catch those turns pretty doggone well because I confluence it with that Fibonacci's I learned from you and my levels. And this Australian dollar is a pretty good example right here. Is it what you want to do is when you're doing the Fibonacci, you want to do it with the most recent high. That's fine. But sometimes if the most recent high, they're all clustered together, as they are here, you're better off doing it from the most significant high. Because you could, like you were saying, that maybe that gentleman saying, okay, I'm doing a Fibonacci from here, from this high to this low. Yeah, but you have to go with the most significant high. Now, most of the time what I'll do is I'll do a Fibonacci, which is fine. You can do a Fibonacci of the most recent high and low of a range. But if they're all, in this case, clustered together, like we are here, then you're better off doing the Fibonacci from the main key recent high and recent low. You see here, if you put it in perspective, you're saying, well, what the heck are you doing Fibonacci's from here and here and here? You have to do it from the most recent high and the most recent low we had, which is another thing, is that maybe the gentleman's trying to do it from here and here. So if you look here, give an example here on the Australian dollar, right there, you can see where the market runs up to the 38%, which Blake is showing. I've got mine colored. Y'all can do them the way you want. I've got mine colored where the green is at 38%. I have the black as a 50%. The key main ones that Blake has always pointed out are going to be the 38% and the 61%. And Blake actually addressed this about 3 days ago or so. He was mentioning about the Fibonacci, where that you can if you go back to a 38%. Whether you pull back or you retrace back to 38%, you still maintain your range. Once you get to about the 61%, that's about as far as you're going to go, where you can still maintain the general trend of the market. Meaning, if we pulled up back into the 61% here, the market could still resume its downtrend. Once we get past it, then people start to go on and question, hey, do we still are we still going to keep this downtrend? It looks like maybe we're going to go on and turn it the other way. Another good example is, and I always like to mark my Fibonacci's. You can see here on the table here, and I usually mark it 2666 to 3372. And once again, as Blake was pointing out, you got to go on and mark them with the most recent high and the most recent low of a move. And I would say the most recent significant high. So if you back this up, you can see that we've had, after the market sold off here, we had a pretty good run all the way back up in here to this 3372. So if you go on and run the Fibonacci here, from the most recent significant high here and to this most low here, you can see the market ran out of gas here at the 61%, and it falls all the way back. And then the market starts reasserting itself here. So once again, I've said it to people lots of times before, but that webinar with Blake's really was a big, huge turning point to me. I'll give you another example here. Here's on the dollar Swiss, and I never used to follow the dollar Swiss that much. I used to about 2 years ago, or I think it was only 3 years ago, but I have started recently because it catches some great turns in the euro dollar. Actually, I posted that chart on Twitter. I think it was on Monday or Friday. I don't remember. I said, if you want to know where the euro is going, you follow the dollar Swiss. And I go and I point out the euro on a 15-minute and the dollar Swiss on a 15-minute. Here's another example right here is on the dollar Swiss, where the market had come back here. And notice how the market, it doesn't seem like a lot, but this is a pretty good move for the Swiss who was trading quietly. Look what runs out of gas, right just before the 38%. After we had a very nice move, the move was good for over 100 pips. We get this move all the way up here, and it runs out of gas just right before the 38%. You have a little bit of a confluence of a level. You got the zone here. And at the time, I told people my target was, and I said that on Friday, once we started to get above the 96, I said the target is 96.39. Well, we made it up to, I think it was 96.49, and I had the 96.55, the 38% confluence. And so that's the best way to trade it is if you can get your areas to either enter or exit coming in with a confluence of a level or zone and a Fibonacci. So that's where it really works out really well. But I keep telling people that's the best $35 I ever spent, or $30, which was that Fibonacci webinar. You can download it and you can watch it over and over and over time. But I tell you what, Fibonacci and FX is absolutely huge. It's pretty key in crude, but in FX, it's freaking unbelievable.
Yeah. Hold on really quick. What I'm going to do... I'm sorry, I'm just had to message somebody.
And here's another example here with the euro, where we made it right up to the 78%. I shorted it that morning live on the webinar. If y'all remember, this is when Blake was out. I shorted it at 13.14. It was 13.14. No, I think it was 13.16. Right in here, we shorted live on the webinar. I remember Elena got on the trade too. I got out too early, as Blake always says. I couldn't hang on to a trade to save my mother's life. But Elena hung on, and she made 58 pips on this trade. So that's what I'm saying. You can see how key Fibonacci is.
I'm gonna use this guy's example, and I'm gonna see if I can do this really quick, Paul. And then I'm gonna show you how backwards this is. I'm not gonna throw him under the bus and tell him who he is or tell anybody who he is, but so he was looking at the New Zealand dollar. All right, so here's a Kiwi, right? Mm-hmm. And he has his fibs drawn like this. Let me go over to a weekly chart. He has his fibs drawn like his chart. He's looking at this chart basically. He has his fibs drawn from like this. Okay. Now. And see what he's looking at is he's looking at this 38% retracement as being important, but it's not because it's already happened. This is way after the fact.
Exactly, yeah.
You know, you paid attention to this was a 618. You held the 618 on the way back. The bounce back, we're in a retracement now from this move.
Exactly.
So now you're looking for the 50% retracement here. This old fib is completely irrelevant. This fib was only relevant on the move. Here, let me grab a pen here. This move was only relevant till here.
Exactly.
Once you got here, this does not exist anymore.
Yeah, because if you look at the significance of that recent high and recent low, that's what you're going to do it off of now.
Right. Yeah,
that's a significant move there.
That is correct. You have to use the most recent move. If that's the same thing of me going, oh look, here's the fib between here and here, and we're at the 618. No. This move here and what had happened at this point in time was only relevant on this retracement right here. That is the only time it was relevant. There is no relevance to it any time in the future. So
and it takes a while to start, because when I first started using Fibonacci, you would always talk about it on the webinar, and I took that bought that recorded webinar, but you would talk about it on the live webinar like you are right now. And I tell you what, it's once you've got it, you can. It's kind of like it seems like it's so obvious, like the way Blake describes it. But when you first start learning Fibonacci, it's a little bit tough. Because you're trying to say, like, what's the significance of these moves, or what do you mean the most recent move, and how to determine that? But I tell you what, over time, and it's going to take you a little time, I'd say it'd take you a few months. I mean, you could take the course and say, okay, I kind of know it, but until you become really good where you can look on this chart and you can pull the stuff up, it'll take you a few months, because it'll take you a few months to learn which move is more significant, just like I showed you on the Australian dollar. And then you'll start to, as you develop a little bit more experience and you get with it, it'll prove invaluable. If you trade in FX, if you don't know Fibonacci, it's just like as if you're engaging in some key endeavor and you're forgetting one main important tool. If you're trading FX, you have to know Fibonacci.
Or I'd say trading anything, but the thing is you have to also know how to apply what
that's what I'm saying. It takes
process.
a little while to learn how to apply.
It does, but you can't regurgitate Fibonacci ratios from like past moves. You're going to end up thinking that things should stop or reverse, or from areas that really are irrelevant. You just remember, you have to look at the way I guess I always look at it is you have to see what the most recent move is and figure out where it's retracing from. So if this is the most recent move, where is it retracing from? If you would have high to low, we're retracing the high to low right now. If you're looking at this move and you're like, okay, well, I want to see from here to here, how far are we going to retrace once we top? Then you're going fibs this way, and so you're looking at levels going this way. On a retracement. That's it. That's all. And if you get caught up in the, well, what did this do to here, and what kind of extension was this, and does that matter now on the way back up again? No, you're going to just end up confusing yourself the whole time. So, but then again, that's me speaking of 20 some odd years of doing fibs, where I know it is a little daunting if you are just trying to apply them for the first time or you're just learning about them. So, and it does take practice. You're correct.
Yeah, and then when you're first starting, it's best to stick with those major fibs. Like I can show y'all where I just showed y'all on the gold. That's an intraday fib somewhat. The most recent move from 1335 to 1361, which would be in 48.5 being the 50%. So you can do it on a very, very short-term basis, but when you're first starting out, it's best just to concentrate on those fibs, on those big, key, significant moves. Although you can use, and a lot of people do use it, is use Fibonacci on intraday moves, whether it's trading the indices or FX or crude.
Sure. That's why, I was speaking of gold. I mean, this is why the gold currently in its current move, the all of 2016, this is basically a retracement from the move of 2011 down to the lows of 2015. We're just basically, we retraced 38%. That's why it's so important that if gold breaks above 1380, I mean, and by the way, since we're on the topic of gold, Paul, this chart that I tweeted yesterday, which, I didn't tweet a whole lot yesterday. It was my birthday, and I was just,
Oh, it was your birthday yesterday?
Yeah, you didn't know that? Yeah, that's why I'm going to cold. That's why I'm going to Coldplay.
Oh my God, happy birthday! Oh my God, I didn't know it was your
thanks.
birthday.
Yeah, it's my son, my oldest son. It's his favorite band is Coldplay, and so myself and actually we're taking a nephew, my two kids, my wife and I we're all and then a couple friends. We're all going tonight.
Oh, wow.
So yeah, that wasn't cheap.
I told them that tomorrow I'm covering for you tomorrow on the Morning Edge.
Huh?
I'm covering for you tomorrow.
Thank you. Yes. And I appreciate that. I mean, I probably will get home by 11 o'clock tonight, but it's like if I have to get up at 3, I'll be a train wreck. So I'm I'm driving, so I'm not. It's just going to be. I'll be really, really tired. But anyway, but what I was saying is, sorry, that wasn't the topic of conversation. What I was saying with this gold is we're at that 38% retracement, and we're forming this triangle right
Yeah.
below it. And I assume, Paul, that we are going to find some sort of resolution coming out of this triangle by Friday, because Friday, whether you believe it or not, Friday we're going to have Janet Yellen speaking at the Jackson Hole Symposium. She's the keynote speaker. We're going to have a pretty good indication whether the dollar is going to get crushed or rally after Friday. And
I
my
think
assumption,
you're right. You're spot
yeah,
on.
and my assumption is gold is going to show us the way, because if gold breaks higher, that basically suggests that no one believes the Fed's going to raise rates this year. But the significance of gold breaking higher is huge, because if we break above 1380, that means the dollar is going to go into a death spiral for a while. You
No,
know,
you're right. You're
yeah.
right.
So
That's what
yeah,
I mean. Like I told people, I'm kind of when usually I don't refer to the dollar per se. Usually refer to the euro, and best way to describe it is I've told people is I'm euro agnostic in the sense that I'm not like you and I discussed last week. I'm not trying to dog the euro. I sold it last week at 51 and 64, and I got short yesterday at 29. And even though I basically top ticked it, I was only able to catch 15 pips, and that was the best I could do on that market. And I think that we are at a key area, and gold is interesting. And here we are popping up right now around $45 at gold, 1345. Is that we got to that area, thought we got a double top and so forth. But here's the key: we've sold off pretty good, so we've worked off that overbought area. Remember, we were trading at 1360, and then we took that dip, and then we're trading at 1350. We came all the way down to 1335, and now we're in the middle, like right here at 1345. So the market is set up where if it were to get a foothold above that 1380, you're right, it's gone. I think we still at a double top, but if, like you said, if Yellen, which I don't think is going to happen, but if she were to whack the dollar, forget it. You're right, it would go into a dead spot.
yeah,
As far as when
because
it comes to gold.
yeah, because what'll happen is gold will actually break. Gold's going to break out of this triangle, and it's probably going to be on Friday. But the flip side is if we come away from Friday and we go, well shoot, the Fed could actually raise in September, and we as traders may not believe it, but if the market even thinks that there is that possibility, then gold will show us that it's breaking down, and then that will tell us that the euro is going to come down and the dollar is going to rally. I mean, it's really, in my opinion, it's as simple as that. And I don't. That's why I don't think there's anything to do until Friday. I don't think if you're out there, buying the euro or shorting the euro and expecting some sort of direction and trend to emerge ahead of Friday, I think you're gonna have a difficult time. Now, does that mean that you should be buying the euro or selling the euro right now? I mean, I'd be more prone to sell the euro right at this current price. I'm not short the euro right now, but I'd be more in tune with shorting it at this point, just because I think it's at this 113.50 is such a key resistance. I might actually short it this morning. I haven't made the decision just yet.
Yeah,
But
I mean, I had to step away from the desk for a while. I mean, I missed my point. I missed my opportunity to sell the 1350. I don't like selling something again from the same level, so I missed my opportunity at 1350 this morning.
this morning, yeah, I didn't see it was up there. Yeah.
Yeah, I missed my opportunity at gold at 1347. So I'm not going to be pissed off. It just is what it is. I had it, not as far as the euro, but as far as the gold, I had that thing pretty much figured out pretty well, and I just missed that opportunity. But the thing I think is it's tricky because the market is positioned against the dollar pretty good and strong, and I don't think that I think that I think that the risk is for the dollar to go in, and not because I'm always a dollar bull, is for the dollar to go in and rally somewhat, and because I think you have also from a position standpoint, if they have to kind of rebalance things out, because I think that Yellen will say that they're open to raising in September. Whether they do it or not, I don't know, but I can tell you what, I said that on Twitter yesterday. I was pretty adamant. If we see 245K plus and wage gains of 0.3, they will raise in September. You can take that to the bank because that'll be back to back to back 250K job growth. They cannot. Like I said, that people say the Fed's losing credibility. Yeah, y'all are a bunch of idiots that don't know anything. You really are, because
Right.
you know, what was the Fed's mandate? The employment and low inflation. I know people say, well, the 2%, but low inflation. Have they done that? Yes. So how can you say that they don't know what they're doing? You see what I'm saying? Look at your own central banks. They don't know a doggone thing.
Oh, all right, Paul. You're gonna go. Wait, you're gonna go on your central bank rampage.
Well, I know, but my
we're
point is,
almost out of
I
time.
don't think that if they were to lose credibility, they would lose credibility on that.
They already have. They already have.
They haven't.
No one believes what they say. That's, I mean, the fact of the matter. But no, the fact of the matter is, Paul, no one believes that the Fed's going to raise rates. That's why the Fed funds future shows that the very small likelihood of the Fed raising rates by December. That doesn't mean that you aren't right. What that means is the market doesn't believe. The market's fallen now for the last 6 months, 8 months. The idea that the Fed's going to raise rates sometime. It's kind of like, it's kind of like telling like a kid that's, all right, you're grounded. Can I go outside and play? Yeah, you can, but next time you're grounded. They do something bad. Oh, you're grounded. All right, well, can I go play some video games? Okay, but next time you do it again, you're grounded. And then, it's the same thing. The kids will, their immediate response to a parent is, yeah, I'm never going to get grounded. I'm not going to get in trouble for doing anything bad. Same thing in the market. The market's now, the behavior is, I don't care what the Fed says, they're not raising rates. That is a loss of credibility, and that's a problem. Now, whether you believe it or not, it doesn't really matter, because the market totally is immune to what the Fed's actions are right now. In other words, we have to see action from the Fed, because the market will continue to not price it in. Now, you may be right, and the Fed's going to raise rates in September, but I still believe that even if they raise rates in September, the market will be very mispriced, and it will be wrong-footed.
No, you're right about that. You're all right. My point is, I was saying if we got to 45K plus 0.3, they will raise. But no, my think is that the Jackson Hole is that she's not going to be as dovish as people think. I think she's going to be. I think that the dollar's positioned to move higher, because I think that she's going to go on and say that they're open to going and raising. Whether they do or they don't, I think she's going to go and say that. And I think that and I respect the euro for where it's at right now. To be honest with you, I'm less dollar bullish at this point, even though the euro. My point is hey, look, people show their charts after the fact, and I gave some. I just talked some crap on Twitter. I think it was yesterday, because I got tired of people showing charts after the fact. Yeah, this is where
weatherman traders. Yeah.
But the point is that I shorted the euro last week at 13.51 and 13.64. Okay, so but my point is the euro came down to 12.71 or 12.72, and we closed like almost 50 pips higher. That to me, that gave me a lot of respect for the euro right now. And other than this first foray above 13.50, which I missed, I wouldn't mind shorted there. But I'm not interested in shorting the euro at this point. I'm just not, because it defended really well. So I respect technically what it's done so far. I think the risk is that Janet Yellen will just sound minor cautionary, but she'll open the door that they can go in and raise, and that'll allow the dollar to pull back. But I'm not in any way bullish the dollar at this point right now. I'm respecting the euro, because after it sold off from 13.50, 60 area and to 1270 and turned around and came right back up like you said, the analogy of a beach ball trying to hold underwater. I'm respecting the euro right now, so I'm agnostic at this point.
All right. Well, I realized we've actually gone over time. I'm gonna have to put everybody on break here in a moment. But Paul, thanks for your input. JT says I agree with Paul. Watching your fib video is like waving a magic wand over my account. If you don't understand fibs, make sure you send me an email. I'll connect you with the people in Dallas. It's a $30 webinar. I recorded it years ago. And, you can. It's better than reading any type of book because it's instructional.
I will say one last thing, even though we're cutting off right now, is that you see these videos for $199, $500, system for $999, for $35. I guarantee you, it's the best $35 you'll ever spend when it comes.
Thanks, and you watched that before you were a contractor with us, and this is years ago. So, but anyway, thanks, Paul.
Enjoy the concert.
Thank you. I'm really excited to go to Coldplay. Greg in our chat room, he says that's like he doesn't even really like Coldplay, and he said it's like it's supposed to be a really awesome concert. I guess we're getting wristbands
I like Coldplay.
Oh, I love Coldplay. I think they're great, but
of course I love my favorite band. Everybody knows that, Oasis. Now that's a band.
Oh, Oasis.
Nice. Brothers couldn't get along to save their lives. I think Noel's kind of a bit of an a-hole for not getting back together with Liam, but that's a whole different story.
That's great. All right. Hey, Paul, thank you so much. And remember, guys, you can just email me if bmorrow, MORROW @wisetrade.com. I'll forward your information over to the people at the office. When I come back, we're going to start our analysis of all the majors. We're going to start with the euro dollar and work all of our way through. We have market PMI later today, don't we? Yeah, we do. Okay. So thanks, Paul. Appreciate you being here. And guys, I'll see you back here in about 5 minutes. I'm going to go get some coffee. You guys, I'll be back in just a few minutes. Thanks.